In the modern economy, few indicators capture attention quite like market capitalization. It is not merely a measure of valuation, but a reflection of technological leadership, investor confidence, and long-term strategic positioning. Today, we stand at a remarkable juncture in corporate history. Nvidia, once known primarily for gaming graphics, now holds the title of the world's most valuable company, boasting a market capitalization approaching $4.6 trillion. This rise has been fueled almost entirely by the explosive demand for artificial intelligence infrastructure. The question before us is not whether Nvidia has earned this position, it clearly has, but whether it can maintain it. More specifically, could another company overtake Nvidia as the world's largest enterprise by 2026? And if so, which one? At first glance, the list of contenders is short. Only 3 companies possess the scale, capital, and technological depth required to even contemplate such a feat: Apple, Microsoft, and Alphabet. All 3 are giants by any historical standard, yet the path to surpassing Nvidia is narrow and steep. When we examine growth trajectories, strategic positioning, and exposure to the next wave of technological transformation, one candidate stands out more than the others. Let us begin with Apple. Apple remains the second largest publicly traded company in the world and continues to generate extraordinary cash flow. Its ecosystem is unrivaled, its brand loyalty is unmatched, and its balance sheet is among the strongest in corporate history. However, dominance alone does not guarantee future leadership. Apple's core businesses, smartphones, personal computing, and consumer electronics, have reached a level of maturity that limits their growth potential. Over the past several years, Apple has struggled to deliver consistent double-digit revenue expansion. While it excels in operational efficiency and shareholder returns, it lacks a transformative growth engine comparable to artificial intelligence infrastructure or cloud-scale computing. Unless Apple unveils a disruptive new product category or experiences an unforeseen technological breakthrough, it is difficult to envision a scenario in which it meaningfully closes the valuation gap with Nvidia in the near term. As a result, Apple, despite its strength, is unlikely to claim the top position by 2026. That brings us to Microsoft and Alphabet, 2 companies far more directly tied to the future of artificial intelligence. Microsoft has executed one of the most impressive strategic pivots of the past decade. Through its partnership with OpenAI, it has embedded generative AI into virtually every layer of its ecosystem, from Azure to Office to enterprise productivity tools. Rather than competing directly in model development, Microsoft has positioned itself as the infrastructure and distribution backbone for AI adoption across industries. This approach has been highly effective and enormously profitable. However, there is an inherent limitation to this strategy. Microsoft, by design, is a facilitator. It enables others to innovate on top of its platforms rather than owning the core intellectual property behind the most advanced models. While this neutrality provides flexibility and reduces risk, it also constrains long-term upside. If the future of AI becomes increasingly consolidated around proprietary models and vertically integrated hardware-software ecosystems, Microsoft might find itself dependent on partners rather than in full control of its destiny. This strategic nuance leads us to Alphabet. Among all the potential challengers, Alphabet appears uniquely positioned to challenge Nvidia's dominance. Entering 2025, Alphabet faced several critical uncertainties: regulatory pressure, skepticism about its AI competitiveness, and concerns about the durability of its advertising-driven revenue model. Over the course of the year, however, many of these doubts have been resolved. Google Search has not only maintained its dominance, but evolved. The introduction of AI-driven search summaries and contextual responses has strengthened user engagement while preserving the company's advertising moat. Contrary to early fears, AI did not erode Google's relevance, it reinforced it. At the same time, Google's Gemini model has emerged as one of the most capable generative AI platforms available. Competing directly with OpenAI's offerings, Gemini has demonstrated strong performance across text, code, and multimodal reasoning. Importantly, Alphabet controls every layer of this stack, from data and models to infrastructure and distribution. This vertical integration gives the company strategic flexibility that few others possess. Equally significant is the resolution of major regulatory uncertainty. With courts declining to force a breakup of the company, Alphabet now operates without the overhang of existential legal risk. This clarity allows investors to evaluate the business on its fundamentals rather than hypothetical restructuring scenarios. But perhaps the most intriguing development lies in Alphabet's hardware ambitions. Alphabet, alongside Meta, have been developing custom tensor processing units, or TPUs, designed specifically for AI workloads. These chips have historically been used internally, but reports suggest they may soon be commercialized and offered more broadly. Should that happen, the implications could be profound. Nvidia's dominance rests on its GPUs being the default choice for AI training and inference. If TPUs emerge as a cost-effective and performant alternative, particularly within cloud environments, Nvidia's grip on the market could weaken. In this scenario, Alphabet would not only be competing with Nvidia in software and services, but directly challenging it in the foundational hardware layer of AI. That combination, cloud infrastructure, proprietary chips, leading AI models, and a global user base, is extraordinarily powerful. There is also a wildcard factor: Alphabet's minority stake in SpaceX. While not central to its core business, a potential SpaceX public offering could materially boost Alphabet's valuation. Even if Alphabet chooses not to divest, market recognition of that embedded value could further enhance investor sentiment. That said, it is unlikely that this factor alone would propel Alphabet past Nvidia. Ultimately, the decisive variable is Nvidia itself. The company's valuation assumes continued explosive growth in data center spending, AI model scaling, and enterprise demand. If that momentum continues uninterrupted, Nvidia may well remain the world's most valuable company for years to come. However, if capital expenditures slow, if alternative chip architectures gain traction, or if large customers begin to diversify away from Nvidia hardware, the balance could shift quickly. In such a scenario, Alphabet stands as the most credible challenger. It has the scale, the technology, the talent, and the strategic coherence to capitalize on any weakness in Nvidia's position. While overtaking Nvidia by 2026 remains a formidable challenge, it is not implausible. In conclusion, the race for corporate supremacy in the AI era is far from settled. Nvidia currently leads, powered by extraordinary demand and unmatched execution. Apple remains a pillar of stability but lacks a clear growth catalyst. Microsoft is a master of platform leverage, yet strategically constrained by its role as an enabler rather than a controller. Alphabet, however, occupies a unique position at the intersection of infrastructure, intelligence, and innovation. If the next phase of AI development rewards vertical integration and proprietary ecosystems, Alphabet may very well emerge as the world's most valuable company. The coming years will determine whether Nvidia's reign is the beginning of a long dynasty or the peak before a new leader takes its place.